Hi, I'm Pattu from freefincal. I've been doing a series on market timing and I've been backtesting a strategy based on double moving averages with the S&P 500, the Nasdaq 100, gold, INR and USD. Then I used gilts with gilt yields. So the method with the double moving averages, with the 6 months moving average and the 12-month moving average, worked reasonably well for all these asset classes and indices. But then when it comes to Indian indices, when it comes to the Sensex, when it comes to Nifty Next 50, Nifty Mid Cap and so on, it dramatically fails. That's what I mean by a risk in market timing that 122 years of backtesting failed to reveal. It's that 122 years is the S&P 500 data. So what I would like to point out here is that you can do any kind of you can come up with any kind of backtesting method, and many people on YouTube simply claim that X and Y method works without even showing any kind of data. But even if you have a method that works 100% of the time in your backtest, and in this case it almost worked 100% of the times over 122 years, there is no guarantee that it will work for you when you try it on some other index or in the same index. After you start putting your own money, there's no guarantee it will work. That's what I mean by sequence of returns risk. Sequence of returns risk is present both in market timing as well as systematic investing. Systematic investing sequence of risk I've talked about several times in the past. I will again talk about it maybe in a couple of days time. But this is sequence of returns risk with respect to market timing. So the strategy is very simple. So you take the 6 months moving average, you take the 12 months moving average. If the 6 months moving average is greater than the 12 months moving average, that is the market has got upward momentum, then you are completely in equity or 100% equity. If the 6 months moving average falls below the 12 month moving average, the market has lost momentum and therefore you are completely in debt. Completely in equity means you sell all your debt holdings and push it into equity. Future investments also you invest in equity as long as the signal is favorable, 6 months greater than 12 months moving average. On the other hand, completely in debt means you sell all your equity and move to debt, and further investments are also made in debt as long as the signal is favorable for debt investing. So this is momentum investing. It is the opposite of buying low and selling high. And in fact, momentum investing works much better than buying low and selling high, as I have shown in the past. Now, if this I have shown earlier, so this is the 122 years back test. Let's focus only on the top left panel in all the graphs. We're not talking about risk, etc. here. We're just looking at returns. And if you look at the returns, the tactical strategy, that is the double moving average strategy, has almost always done better than the systematic strategy. There are some times where the tactical and systematic are more or less together, but there has not been a single instance where the tactical strategy has gone even below the systematic strategy, and definitely it has never failed dramatically. That is for the S&P 500 in USD. I mean, INR doesn't make much of a difference, but if you look at this, you will say, wow, we have you will definitely say the market timing works. Of course, it works. It has worked more or less all the time in the past. Now, if you do the same strategy with the Sensex or the Nifty over the last 15 years, you can see the last 15 years includes the 2008 crash as well as it includes the 2020 crash. 2008 crash somehow you managed, but the 2020 crash you can see the strategy fails dramatically and the tactical strategy underperforms. So if you look at the back tests, let me just go to the back test first. If you look at the back tests, you can see that the until the March 2020 crash, reasonably the tactical strategy has done better. This is with 50% equity and 50% debt. But after that, after the March 2020 crash, the tactical strategy has dramatically underperformed. And the reason for that is because if you look at this 6 months average, 12 months moving average, and the signal where 6 is greater than 12, you can see here during the March 2020 crash, the price dropped rapidly down. It was one of the most steepest falls seen in history, and nowhere in the past of both the Sensex and the S&P 500 has the price deviated so much below both the averages. And because of that, there's a huge buying opportunity here which was missed completely, and then the recovery started immediately, but the buying, because of this model, the buying started much later than the recovery. So there was a big gap here. Because of that, the returns of the tactical strategy failed. So that is an example of a market timing strategy that has failed due to a poor. There's a very particular sequence of returns. So because of that one particular sequence of returns involving this great deviation of the price below the averages, all the runs that involve this deviation have failed. And this is with respect to 50% equity and 50% debt. And if you increase the equity to 70%, then also the failure is there. But then the previous outperformance has come down a little bit, because 50-50 asset allocation is slightly more, less aggressive than 70% asset allocation. So the message here is that you can look at any strategy, whether it is systematic or tactical. The same risk applies to systematic investing as well. Don't assume that systematic investing is the best, SIP is the best, market timing is complicated. Don't start such rhetoric. Whatever strategy you follow, nothing will work all the time. There is always a risk of poor sequence of returns, and no matter what you see in the backtest, there can always be some weird, unique sequence of returns that can affect you after you have started investing following some strategy, including the great SIP, which can result in poor returns. So I'm not trying to say market timing doesn't work. Yes, you can definitely time the market. There are definitely strategies that allow you to time the market with lower risk, higher risk, sometimes higher reward, sometimes lower reward. But no strategy will work all the time. That is what you should understand. Market timing works, but it will not work all the time. Same case with systematic investing. Systematic investing will work all the time. Systematic investing works, but it doesn't work all the time. Excuse me. Sometimes it will work, sometimes it will fail. That is the risk that you have to you have to take. I have shown this several times before by showing you rolling returns. If you look at the rolling returns of 15 years, 20 years, 10 years, sometimes returns will be as high as 15%, 20%. Sometimes it will be as low as 5%. If you are going to get 5%, 6% returns from the Sensex or the Nifty or any equity fund after 10 years or 15 years, you have failed. There is no two things about it. Systematic investing has failed. It has failed in the past. It can fail in the past. So the sequence of returns risk is what we need to be aware of while investing in equity. I will make another video. I have already made videos in the past, but I'll make another video showing you how dramatically sequence of returns can change your the fate of our investments in a couple of days. This is for systematic investing.